Okay, it's time. Good afternoon, everybody. I'm very happy to have you here, and I'm especially very happy to have a very great podium here, panel. And I'm also happy about the subject we talk about. I think it's very up to date. It's one of the big subjects, not only for investors, it's also in economic terms a very big and important subject. I mean, it's about China, it's about emerging markets, you know about the geopolitical tensions, about the domestic imbalances in China, about political and legal developments and risks. Currency risk is a subject, interest rate risk is a subject, correlation between emerging markets, high debt and transparency. I think we will touch them, all of them or part of them, because we are a lot and we have a lot, not so much time. So I think we start by introducing, everybody will introduce himself and also say where his special expertise is in this subject, in this topic. So I think I start with Mr. Perryman. So.
Hi, Chris Perryman. I'm an EM Corporate Portfolio Manager at PineBridge Investments. In terms of specialization, we run an Article 9 fund. So for me, ESG is part of my daily work. And also, obviously, we have a very big team across Asia and Latin America in terms of research. So happy to talk on corporate anything.
Great.
So I'm Bevan. I work at Aberdeen, Investment Director there, also specializing in EM corporate debt. And I am lead manager also on an Article 9 fund that's specializing in aligning investments with the Sustainable Development Goals.
Hi, everyone. My name is Yuhn. I'm a EM debt portfolio manager at Man Group. I manage the EM debt total return strategy for the firm, which means it's an absolute return strategy unconstrained. So in that regard, I cover both hard currency and local currency for emerging markets.
Hello, my name is Wouter van Overfelt. I work in Von Tobel. I'm responsible for EM corporate bonds, also hard currency.
Okay, we have 2 times heard today currency. Start with something that is very, off the day, because this evening the Fed will, we expect to raise its interest rate, maybe the last time. But let's talk about the influence of the Fed policy on emerging markets and especially on China, and also about the risks for investors in that direction. Maybe, I don't know, maybe Mr. Yuhn wants to start, and everybody who wants to tell.
Yeah, sure. So I have 2 different thoughts, just broadly speaking. I think the first impact that monetary policy tightening has had on emerging markets has been most deeply impacting the frontier market countries. So when you look at the frontier market countries in emerging markets, so we're talking about some of the sub-Saharan African countries, some of the South Asian countries as well too, these are countries that maybe 10, 15 years ago didn't have access to the Eurobond market. And then quantitative easing came, and then they were to get easy access because it was an environment where everybody was looking for yield. And then quantitative easing, of course, turned into quantitative tightening about 1.5 years ago. And so now what you're starting to see is that access to markets has really dried up, and that's really impacted, first and foremost, frontier markets. So when you look at the issuance data that came out, you saw that issuance in emerging markets hard currency debt fell by over 50% from 2021 into 2022. And in particular, it was a frontier market issuance that really dried up. And so that's why it's not surprising that now you are starting to see defaults that you had not seen before because of the impact of monetary policy tightening. So now you see, the Sri Lankas, the Zambias, the weaker hands that are really starting to default. So that's one part of it. However, the more positive story is that in the past, when you had monetary policy tightening to the level it has, which has been unprecedented in most of our lifetimes, you would see an accident, and almost always accident is in emerging markets. So in the mid-90s, you had the Mexico tequila crisis. 97, Russia defaulted. 98, you had Asia currency crisis. And these are all fairly large countries that we know today, the Mexicos, Brazils, Koreas of the world. But today, you don't see that. It's really just in the weakest hands. So today, countries like Brazil, Mexico, Colombia, Korea, they've been managing this quite well. You have not seen the contagion effect. And a lot of that is because these countries have learned. They've established best practices from developed market central banks. So you have inflation targeting. You have currencies that were pegged before that are now free floating, so they can absorb the external shocks, and they have high levels of reserves as well too. So I think in one sense, it's obviously impacted the weaker hands, but on the other hand, the better quality countries have been able to manage it well.
That's, I think, is the very important point you make, and I want to know more about that from the other panelists, that you don't see, we have one of the highest, of the most fastest raising of interest rates in the US in history. So normally you would expect there will be a big crisis. So which of these factors you just was saying, I mean, also the other panelists, is most important? One I often read about is, what you also mentioned, is the reserves. They don't take so much debt in dollars. They take it in their own currency. That is one question I want to give to the whole panel here. The other is the risk really over? Is there anywhere a pocket of danger you would stress we have to watch? So who wants?
I don't mind picking up on EM corporate debt specifically. Our expectation is that a lot of these companies that issued high-yield debt were able to term out debt. So there isn't actually a maturity wall in the coming 2 years. It's much more of a 2025, 2026 story where there's a larger rolling over of debt is needed. So really it's the direction of travel for the Fed that is going to be the most important piece in terms of market access. Mm-hmm. So when that pivot happens and the pace of that pivot is going to really determine market access for a lot of these EM high-yield names. Because if they were to have to come to the market today, the rates at which they have to issue is not sustainable for some of the business models. So if we still have a situation of very high terminal rates 2 years down the line, that's going to be a much bigger risk for the market. But at the moment, there is sufficient breathing space and balance sheets are healthy enough that default rates outside of some like stress areas, like China real estate, which has been well covered, should be fairly muted, in our opinion.
Somebody else, something?
Yeah, I was just going to say, I think one of the other factors that people are looking at more in EM space, and it's not a new issue for us, is dealing with inflation. So if you look at EM central banks, they've been able to affect normal monetary policy, whereas the Fed and the other Diem central banks are dealing with a lot of other issues and baggage that came with their easy monetary policy. Right? So from our point of view, inflation is actually a really easy one for EM. It's something they're used to and they deal with on a daily basis. Also, the growth differential between EM and DM is continuing to be positive, and we don't see that changing through 2023 or 2024. So I think EM fundamentally is in a much stronger footing than the last 20 years, and so it is a difference that is fundamental and strong for EM. The other point, to Phil's point, is EM is able to isolate risk now. It is a much more idiosyncratic story that you deal with. There's no risk on, risk off. You know, it's a large fundamental asset class driven by strong information that is available now for people. So in EM corporates, for instance, you know, it's a $2.6 trillion market now. This isn't 800 billion, you know, all in, all out. It's just very different.
Mr. Overfelt, he already lifted the view on the whole universe of investing in the emerging markets. And we see very good returns there, but we also know there are risks. We have talking about the currency risk. You see them not so big at the moment. We have the other ones like legal risk, like the geopolitical situation and so on. Mm-hmm. I mean, higher earnings is normally is not so special when you have higher risk. You get more for the risk you get in. But is it when you go after the risk, is it still worthwhile to invest, and why? Is it pays more than the risks?
Yeah, I think I do think it's worthwhile taking the risk. First of all, I do think geopolitical tensions, as we see today with China, US, of course, are more on the forefront. Also with the war in Russia, has come to the forefront. But I do think that investing in emerging markets is always about investing in political risk in a way. If you look at company fundamentals, emerging market corporates versus developed market corporates, they tend to be better, lower leverage, etc., because companies know their crisis and they are confronted with this political risk that is actually much more impactful in many ways. And then, of course, I do think that credit selection is, of course, key. If you buy the wrong credits, of course, you can lose a lot of money. But on the other hand side, as my colleague indicated, it's a very big asset class. You have various different countries, different industries, different phases in the cycle, exporters, importers, so there's a lot of opportunities. And that's also why we think it's an ideal space for active managers that do take active risks and do their credit work. And I do think that in such cases, rewards can be very high indeed from investing in the asset class.
Okay, first I want to know from the other panelists if they share this view, and maybe you can go a little bit deeper. Where is the risk higher? Where is it lower? I mean, we can talk about countries, we can talk about especially China, and also about the asset classes. Which asset class would you say is more worthwhile? Maybe even about which industry, and where you would be more careful.
Okay. Can I maybe?
Yeah, sure.
Yeah, I think on the types of risks, what I usually try to explain to investors is that very often people, when they invest in fixed income, they don't make a clear so they talk about risk, but they don't make a clear distinction between, let's say, interest rate risk, credit risk, liquidity risk. And I think that's actually really important to make that distinction. And today we are in this rising rate environment where I do think interest rate risk have been more important and then translate in a second stage into the default risk and refinancing risk. But I do think it's actually really important to make the differentiation between credit risk, interest rate risk, and be conscious on where exactly you do take.
Just to make it clear, you would say the interest rate risk is highest. We have seen it the last days in the US, these interest risk results. Do you see them also highest in the emerging market investments?
Well, I do think that on emerging markets, corporates, I think interest rate risk is a little bit lower than, for example, sovereign risk, because people tend to be more afraid about default risk, and therefore they don't finance companies for such a long period of time. Whereas on the sovereign side, you have a higher duration, higher interest rate sensitivity. And then, of course, investment grade has more interest rate risk than high yield, because high yield is more about the credit risk. And I do think it's very important for investors to be conscious, okay, which risk am I taking, and am I actually comfortable taking this risk?
Okay, the other ones, please.
Yeah, and the way I was going to answer it, instead of talking about what we think is worthwhile from my team's perspective, I'd actually talk first about what the market is thinking right now. So I think one of the consensus trades in the market right now in emerging markets is to be short the dollar and to be long not just EM currencies, but other G10 currencies as well too. And my team thinks differently than that. And the reason for that is, and it goes back to what you were asking earlier about potential vulnerabilities and risks in emerging markets. One of the biggest risks right now is a growing debt pile in emerging markets. And now, EM is not an exception, of course, that's happening across the entire world. But for EM in particular, it is worrisome because it has a crowding out effect, right? So when you have all the issuance, somebody needs to buy it, and it crowds out something else, which in the case of emerging markets tends to be private investment. And so that's important because just like a private company, you need to reinvest in order to grow revenue, right? So economies are no different too. You need to reinvest, and they haven't. And so when you look at where currencies are today, everyone will talk about how cheap EM currencies are. Well, then that should be playing out through the numbers. How do you play that out? You would see an improvement in the current account balance where trade balance is the biggest number, because a cheap currency means EM countries will export more, import less, and current accounts improve. In fact, the opposite has happened. Even though currencies are historically cheap levels, the current account balance is actually at the lower end, meaning it's negative. And the reason for that is this lack of investment, because even if commodity prices go up because China reopens, guess what? A lot of the EM countries are producing less of commodities. So you look at a country like Mexico, which is producing half of what they used to produce in oil. Venezuela obviously is an extreme, but even before sanctions were hit by the US, they were now at a third of the production that they were in the past, even though they sit on the largest reserves as well. So,
somebody to add something to that?
Yeah, in terms of risks, I would maybe highlight governance risks, and really getting the call right on governance risks is particularly key in emerging markets and in emerging market corporates. So historically, around half of defaults in EM corporate debt have been down to governance failings. So doing the background work, identifying red flags in governance factors at EM corporates is super important part of the process. You'll hear investors talk about China having higher governance risk, but I think that's sometimes a bit of a lazy assumption. There are very differing spectrums within China. A lot of private companies are very open to engaging with investors and have, like sometimes, in line with international standards in terms of their governance standards. Then maybe you go towards the state-owned enterprises, and it's a little bit less transparent, a bit more of a black hole. So it becomes more difficult to get comfort with that governance piece. And as you see regulators and investors focus more on good governance, the appetite for those companies with weaker governance will continue to drop, so demand for those bonds. So really picking out the leaders in terms of that, I think, is an important approach.
Mr. Perryman, we just heard the government's issues are not so high, if I correctly understood you. I'm a little bit surprised about that. Maybe you want to give your opinion about that, because we had these long discussions about the legal situation there, about the stealing of corporate knowledge and some things, and about also the risk about the political situation in China that was changed in the last years. How do you see these governance issues? Is there a risk, or is there no risk for for investors there?
I'd start with saying it's credit, so there is risk. What I would say is the common misconception about EM is it's materially worse than DM. If you look at cycles, high yield in the US has more defaults than EM in a typical cycle. So actually what you'd look at is very specific cases. And again, for us and to the point of everyone on the panel, is this is about having depth in your research and knowledge. It's not about EM being specifically different in any credit shape. You have to do your credit work. You have to understand. There's 865 in our universe that we can look at. We cover 390 names in our group between 13 analysts. That's how we cover off governance. We meet every management company, and we make decisions based on the meetings, not just the feel or the agency reports or anything like that. The other challenge for EM is obviously credit quality is not a measure just simply by the rating. There's sovereign ceiling caps, so you actually have way higher quality than the rating necessarily implies in somewhere like Turkey, where everything's single B, but that's a sovereign ceiling issue, not a quality of company issue. And the other thing, just in terms of governance, yes, there is bad practice, but as I say, it does stand out, and you can pick it normally. There are exceptions. Obviously, Americanos this year with a fraud. That's not an EM specific. That's just a credit market issue that happens. And the job for us is to be more diligent, be more forensic, and look harder. But as I say, I don't think that's uniquely EM.
But you touched that issue, the issue of debt. Maybe we should talk about that too, because I think the debt in China is really different from developed countries, and it's a high debt. It's almost, how long is ago? Well, I think 2 years ago, that this Evergrande story, and we know that China invests a lot in not very good investments, meaning in the way of about their economic sense. So what do you think about that? This is another risk. Maybe we should touch that in detail. Who wants to say something to that as a risk for investors?
Yes. I think, sorry. I do think indeed that the debt problem in China is well documented for a long time. Of course, we have seen the real estate crisis. That is definitely not over yet. That being said, I do think that a lot of these bonds have either defaulted or are in the process of restructuring, where we, like you mentioned, Evergrande, where we will see some debt for equity swap, probably haircuts as well. So I do think to a certain extent the debt problem is being addressed. Of course, it has implications on the sovereign-owned entities and local governments, what is happening to the economy, and it's to a large extent also, in a way, self-inflicted pain, but also to get sufficient growth for the population. So it's not an easy it's not an easy problem to solve, I think. And so I do think that people need to do their homework and see, okay, are the prices at this moment already reflecting all the bad news? Or so I don't think that because a bond price is trading at a very low level, that it means it's untouchable. It's just a matter of, okay, what is the potential recovery here? And then going back maybe to the governance issue as well, I do think what is crucially important in such situations is also to understand the incentives of the various parties, and the incentives that are on the one hand side, of course, the owners in the company, but also the government, the local governments, regulators, and how they all interact, and what does it actually imply in specific situations for investors.
Okay, I want to touch these questions with the other panelists too, but to take one sentence out of your words before, it means do the homework. I think it's you who offer the funds. You have to do the homework for your clients. So can you say a little bit more how you do the homework?
So this question, yeah, yeah.
Or,
no. I'm happy to answer, but you can give the opportunity to the rest as well.
Yeah, I mean, I guess some of the homework as it relates to China, one of the problems that we know there, and it's not just China, but for a lot of emerging market countries, is the quality of the data, right? Mm-hmm. And so what you need to do is to start to identify independent third-party research that you think is fairly reliable, and to start to look at the integrity of the data there and to scrub it yourself. And so that's one part of it. The other part I was going to answer in terms of your question about the debt, just to put some numbers on there. There's been 3 times over the last 20 years where the Chinese government has injected meaningful stimulus into their economy. One was after the global financial crisis, of course. The second part was late 2015 when you had a global economic slowdown, oil prices fell by half, and then obviously most recently with 2020 COVID. The difference this time compared to the other 2 was that as soon as they put the stimulus in, they were very quick to take it out. And even though the Chinese economy was under lockdown even longer than we were in the West, instead of putting more stimulus in to help it up, they actually still kept stimulus at fairly low levels. So what's changed? It's the debt level, right? So when you look at the global financial crisis, when you look at household debt in China as a percent of disposable income, it was 20% in 2008. So very, very low. They could do as much stimulus as they want with no fear of a bubble. Late 2015, it doubled, but still 40% is reasonable. And then most recently, even before COVID hit, they had reached 100%. So now you do have a bubble problem, which we know after the fact was a property market. So if anything, they've been needing to de-lever, and so that's why they can't put as much stimulus in, and that's obviously has repercussions for not just China, but for global economy.
Somebody wants to add something to that?
In terms of doing your homework, I do think in an EM context, it's really important to go and get out on the ground and meet companies, regulators, policymakers on their home turf. You often glean information that is not out there from doing that, from those conversations. And in China, we have an onshore team as well. There's a lot of information asymmetry when investing in China. So having people on the ground in China, close to regulation, close to the companies, close to all the internet rumors that drive prices, is an important piece of the puzzle for us. And we even have ESG specialists based in China as well. So I think in terms of doing your homework, you do need the depth of resources to cover EM. You're talking about 80 plus countries, and as you mentioned, over 800 corporate issuers.
Okay, Mr. Perryman, you want to add something to that? ESG will be a subject later.
I guess two points. One, to Sam's point, like you need depth and strength. So we have analysts again on the ground in Asia. If you look east to west, the view on China is very different. If you look at how it's written and understood, that creates a difference in pricing, which sometimes can be an opportunity. Sometimes it's justified. Depends on really your takeaways and how deep you can go. In terms of China, one thing I would say is I think the other difference and change to stimulus is policy-led this time, right? So I think for me it's more focus. The China authorities want certain industries and sectors to be controlled by them, property being one of them. I think private sector influence was too high for the China policy. And if you look now, the way the stimulus is unfolding, it's really consumer-led. And there's that creates a GDP growth which is between 5 and 5.7% this year, which I think for a lot of people is a surprise because it's a really low number, but on a relative basis actually is a good number. And I think the pace at which stimulus comes as well, to Phil's point, is slower this time and is going to be slower. So, I think people have been disappointed by China, and that's why you get a emergence of, is EM under too much debt? Is there issues? Is there problems? Is because this stimulus is slow and deliberate. It's not turning the taps on. It's focused. So end of Q2, Q3, you will start seeing those benefits. We've already started seeing better prints in GDP. We've started seeing that growth come through, but it's not going to be the record-breaking stimulus packages that have been before.
Maybe there's an important point you all touched a little bit, and this is the Chinese growth model, that China wants to change it. They want to have a higher consumer-based economy away from investments. That makes no more sense. We had the last numbers were encouraging. There was, I think, more than 10% retail sales. And, but it means, on the other side, there is not the same growth rate than we have seen before in the last decades. There was higher than 10%. Now the goal is 5%. What is the meaning of this new growth model, first, for investors? And second, how do you think, does it work? Is the Chinese government really able to change that? The latest numbers seem to be encouraging, but it's too little time to judge that. So who wants?
I don't mind starting on, so that there's definitely a pivot in China towards green technology, particularly electric vehicles. We think it's a really big growth opportunity. So increasing demand and boosting demand in electric vehicles solves a lot of problems for China. They import a lot of oil, 90% of which goes towards cars. And cities are very polluted in China. So the pivot towards EVs solves two of those big issues. EVs are like 30% of new demand at the moment, but only 5% of the total market. So there's huge growth still to come in electric vehicles. China, there was recently the Shanghai Auto Show, and China is leading on technology there. A company, Geely, produces an electric vehicle that can go 1,000 kilometers, which is twice as far as any Tesla. They're the leader in electric batteries as well. For EVs, they have a 40% market share there. CATL, which is a debt issuer that produces electric batteries, has come out with a model that can go twice as far, but is half the weight. So they're really pioneering some interesting technology that is going to be key for the global transition, and that's really where China is trying to position itself at the moment.
Somebody else something to this change of?
Yeah, so I'll add something to that. So, the China today obviously is different from the China of yesteryear. And I told you before, one of the consensus views in our markets is to be short the dollar and being long EM currencies. Within EM currencies, probably the biggest consensus trade is to be long Latin American currencies. And the reason for that is kind of this China-led story, because in the past, when China grows, all the commodity exporters, Latin America being obviously a key beneficiary with Brazil, Chile, and Colombia, just to name a few, would always benefit from it. Now, the difference, though, is that back in the early 2000s when China was growing, one, it was growing at double-digit rates, but it was also investment-driven, right? So investments as a percent of GDP, I think, in the beginning of 2000 was at 20% and essentially doubled. So over that time, EM certainly benefited as investments was being led. Today, it's opposite for the reasons that you mentioned, more consumer-driven, which means even though investments are still relatively high in an absolute level, it's coming downward, right? And so we know, again, that the property market, they're probably trying to delever it. It might not be a hard landing, but it has implications now for commodity consumption and for our countries as well, too. And then the numbers you were talking about, even though it was a very high GDP print, again, as you mentioned, it was consumer-driven. When you look at the investment segment of it, it came in below consensus, so it kind of reflects this new China, if you will.
Good sign, then. The latest development.
Yeah.
Okay. Somebody else something to the growth model of China? Otherwise, maybe we can go deeper in the ESG part, I mean, at least we had always a little bit impression China is not as far there, but maybe this impression is wrong. I mean, maybe Mr. Perryman wants to say something about that. You told me, or you told the audience here that this is a special subject of you.
Yeah, so I think to Sam's point, China are investing and making change. They have the biggest move to make, so therefore, you have to be involved. I think for most ESG people in Europe, they understand that you're investing in transition and change. You're not investing in or trying to exclude at this stage. So I think that's a very key difference to the approach 10 years ago, perhaps. And I think also if you look in China and Hong Kong in particular, the regulatory environment for funds there is definitely needing more conscious around ESG. Our office there and in Singapore, we're having to work and fulfill regulatory needs as well as end client needs on change within the ESG sphere. So I think for me, it's an inevitable focus. It's a long-term risk factor, regardless of where you feel politically about ESG. It's ultimately a long-term risk factor for all these companies. If you're a mining company that doesn't manage your waste, you're going to have very serious issues with your sites. In 10 years' time, you're not going to have any water, which is a very key part of mining. It's to China's growth potential and point. If their focus is on EV, they need the raw materials, and they need that to come in a better way than currently is produced. If you look at Apple and the supply chain problems they're going to have for sourcing cobalt at some point, they're going to have ESG-focused companies doing that. And so for us, encouraging those companies now to change means long-term they have better outcomes and are able to service their debt at the very least, and if not grow, better companies, more sustainable companies.
Maybe the others, just one question to that, maybe. China gets the Russian oil cheaper. They have a discount on that. Has this any importance for the ESG development, meaning maybe the incentives are a little bit less high, at least in the carbon part, in the oil part? Whoever wants.
I'm not an expert on Russian oil to China, but what I would say is, however, that China is changing quite a lot also in terms of renewables. And so very often, away from this China oil in Russia, there's a lot of focus sometimes on coal-fired, and they're the biggest producer of coal. I don't know. But I do think they're also investing a lot in renewable energy, and they're actually a leader in the world on renewable energy as well. So yeah, China needs a lot of energy, and I think they're doing their part on the renewable side, but also, yeah.
There are enough incentives still. Somebody else, something to that?
I think when people hear ESG, they tend to think of risks, but in my view, there's actually lots of opportunities there, particularly with sustainable development and particularly in EM, given that you have the highest inequalities generally between developed markets and emerging markets. So you don't only have opportunities in climate solutions like renewable powers and green buildings and electric vehicles, but you have opportunities to really tackle inequalities like investing in essential infrastructure like access to the internet, access to water and sanitation, access to healthcare, financial inclusion. These are big themes to be played out in EM because these issues are most acute in those countries. And it doesn't have to be just a risk. There's a huge opportunity there to solve these problems.
Just feel like one last question from my side, then I give it to the audience. There is a big discussion about the dollar in the last few weeks. For me, a little bit strange because nothing big changed. And there is always the discussion if the renminbi once can take the role of the dollar. I just want to know from your side how you judge that. And then we go to the audience.
Sure. I guess I'll take a first stab at that. So I think it's very premature and a bit overstated, and maybe this is my American bias coming out a bit here, but I still think that everyone talking about the dollar having seen its better days and coming behind us is very much overstated, and the numbers show that, right? So when you look at reserves in the world, right, dollar as a percent of the reserves in the world has been fairly steady around 60%, comes down a little bit. The renminbi, on the other hand, is still very much in low single digits. The only other currency that's out there that even comes remotely close is the euro, which, as you know, has been around for quite some time. And even with that, it's kind of topped out at 20%, and it's kind of been falling as well, too. More importantly, though, 2 more points is global transactions, right? So you want transactions to become a reserve currency. They're also, the US is by far the biggest component, and it's held steady for the last 20 years. You don't see any material dip there. Whereas again, transactions in renminbi is still at very, very low levels as well, too. And then the last point I would mention here is that if you are going to be a reserve currency, you need it to be obviously a free-floating mechanism. Right now, the renminbi is still very much a very closely controlled currency, and we tend to forget, but it wasn't that long ago, back in 2015, 2016, when China was experienced sizable capital outflows, right? And so their reserves fell by $1 trillion at that time. These are the type of episodes that the Chinese authorities are very wary of, and that's why they still hold control to this day.
Is there another opinion about that? Think not. Yes. Otherwise, yeah. Who has a question in the audience? I have a micro here.
May I start?
You can get the micro.
How do you see the problems, US, the geopolitical problems within the US and China? How do you see the future? Will it end up in a war or an economical war, or what is the best and the worst consequences? Thank you. And when do you think that confidence is coming back into China? Thank you.
I want to know these answers here too.
I think even the US
Great.
administration wouldn't answer your question.
What are the opinions here on the podium? I'm really interested.
I think for being an asset manager who's involved in China, the first thing you have to understand is where the implications are going to be for sanctions and how far-reaching they can be. And I think for us, they're fairly predictable in the current environment. I think obviously the US election is probably the key risk to that coming up, that we have to then understand whether the pivot or change is going to be. Biden or Trump is an interesting prospect for that to understand. But again, for us, it's really translating that into what sectors will that affect. Tech is clearly the focus at the moment. And that's really where you have to look. I think in terms of escalation and politics, everyone hopes that doesn't go down that route, and it's very hard to see, being a logical person, how that comes about, and to what end or benefit it is to either party involved in that outcome, right? So from our side, as I say, the focus is always on the sanction risk and whether that increases.
On the tech point, you can kind of understand why semiconductors are particularly in scope and of interest to China, because they don't have onshore expertise there, whereas they are very reliant on imports there. And semiconductors is so important to all of this EV and solar panels, renewables, etc. All of this green tech needs semiconductors. That's why the Taiwan problem is a bit of an issue, because they're one of the largest exporters of semiconductors, and why it's of particular interest of China to flex their muscles with Taiwan. So it's a risk that I think is going to be there in the background, and one to be cognizant of for investors, for sure.
Yeah. The one thing I would just add there is, if there's one thing that Democrats and Republicans can agree on, which is very, very little in the U.S., is China, right? So it's maybe a matter of slightly different policies, but they both are incentivized to take a tough stance on China. I don't think any of us here can predict war or no war, but I think that given that stance, what is fairly clear, as you see it right now, is this deglobalization trend, right? And so one of the ways we've seen that is in the United States, semiconductors is obviously a very key component of today's modern economy. And so you start to see the US government start to give subsidies to give to companies like Texas Instruments and other domestic semicon chip makers to build within the US. So that has obviously fairly larger ramifications for the global trade aspect.
Just something to add as a question here. You talked about Trump and this hard line he has against China, but Biden is only speaking nicer. It's not so different in his policy against China. You would agree here?
Yeah, I would agree, and that's why I said, I mean, again, the Democrats and Republicans do not agree on pretty much anything, except this is probably the one area where there's certainly overlap.
Okay, I want to give the opportunity to you. It's a short time anyway.
Yeah. Just, you haven't touched India. And I think, where did you see the credit cycle there? You know, the way the banks operating there, you know, Andani Enterprises, you know, did that affect you, etc., etc.? Can you elaborate a bit on India?
Yeah, we heard it's in population bigger than China soon. So yeah, it's an interesting question.
I don't mind starting on India. It's one of our largest overweights in our funds. One of the big growth engines of the world, like, can grow above 7% this year. And the capex cycle is turning in India, particularly as they focus on, again, climate transition. So that grid is 70% reliant on thermal coal still. There's a huge amount of money pouring into renewable power generation in India, and including having access to the full supply chain within that space. In terms of the banks, we think that they're very stable in India. It's much more of a domestic banking economy and a big microfinance economy again. So you can find lots of opportunities within the microfinance space. So India, yes, the Adani governance issue has definitely spooked some investors, but that's where you have to do that due diligence on governance. And Adani was a clear red flag in terms of governance. If you just put it through the litmus test, it was clear that there were issues at that entity.
Something to add from the others here?
Well, actually, yeah, the Adani issue actually created opportunities in renewables because they were trading extremely tight because they're really the only alternative for China. So if you look at Asian investors in the Jackie setup, China is a large percentage of domestic money. And if they don't like China from a dollar debt perspective, India becomes the beneficiary. And then you see levels for risk not really looking good. What Adani did was create that blowout, and it was linear. So, you know, there was a parallel shift, and then you could create that differentiation and take the opportunities. So, yeah, I think for me, India is an opportunity set that's very focused on change. The pace of change may be the question that a lot of people ask India, and their reliance on coal and the investment that they're making in coal is creating questions around that. But for us, yeah, the renewable sector is growing.
Okay, we have just 3 minutes. That is enough for the next and maybe last question.
My name is Hayal. I was born in Saudi Arabia, so I'm very interested to see where Saudi Arabia would fit in your thesis for investment and emerging markets. I would start with Phil, please.
Sure. So, you know, the obvious part is that the uptick in oil prices after hitting recent lows has benefited Saudi Arabia greatly, right? So when you look at all their current account balances, all these other external accounts, it's done quite well in that time period. And while we're not commodity experts per se, I think that given the way OPEC has been operating, I think that they've signaled clearly that there's a certain floor that they're willing to tolerate in terms of oil prices, which would only benefit the oil-producing countries such as Saudi Arabia there. So from our perspective, the only question mark there is valuation, right? So Saudi Arabia is a solid, high-quality rated country, very little to low levels of default risk, but the spreads are reflected right now too. So I think for us, we just rather wait for a better entry point to invest in a country like that.
I think maybe everybody a last word, what he thinks is the most important point we have touched today, and then we would close this event. Starting maybe, there's Mr. Perryman.
Okay, give me no time to think. Thank you. So I guess from my perspective, I think EM is a grown-up asset class. It's 20 years away from most people's perception of it. So in terms of risk management, you know, most of the risks now are idiosyncratic and manageable. It's a broad church in terms of investment opportunities that through a cycle we can manage. And active managers are probably best placed to benefit from that in terms of where we are in the cycle right now.
Okay, next, whoever.
Well, I would concur. So I think there's a lot of opportunities within emerging markets. They're often misunderstood because of headline risks. But I agree. So there's a lot of opportunities and you asked for the key message. So I think we all agree people should do their homework, have the local knowledge probably, and then there are a lot of opportunities in the market.
And not surprisingly, as an active manager, I have to agree that active management is very important. But the one thing I would throw in there to say why active management is important is that you look at what's happened in the world, right? So when you look at post-global financial crisis all the way up until 2 years ago, it was quantitative easing, so it was all very much a beta story. So yeah, there was always a bottoms-up selection that you needed active management, but it became less relevant in a world where QE and the world was awash with liquidity. Now it's clearly shifted, and you may agree or disagree, and we'll get a first taste today with the Fed and what they do and what they signal. But I think at the very least, what we have to admit now is we're in a different environment today, right? It's no longer a given that QE can start right back up again. Inflation dynamics are different. Debt dynamics are different too. And so that again goes back to what my fellow panelists here are saying. It's about active management, choosing the winners, avoiding the losers.
Mr. Bevan?
And I just say in terms of an entry point, particularly in EM corporate debt where I specialize, the backup in treasuries has given you a good entry point in terms of yields. You're talking almost 7.5% yield in dollar terms for a 4-year duration, BBB minus rated asset class. Compared to the 5-year average, it was around 5.1%, and the 20-year average 6.1%. So in terms of locking in a decent carry and then trying to mitigate those kind of credit risks, I think it's a good entry point, and an active manager can help mitigate those credit risks.
So thank you very much, all of you on the podium and all of you in the audience. It was a very interesting debate. Have a nice day.